I want to do a little bit of rehash just to make sure everybody's ready for some papers. So some of y'all been struggling on paper 4. There were a few errors in paper 4, so I've saved the file again, but what you have to do, and it's got instructions up at the top, is you take your company for this page right here, the Bloomberg paste values, you just take your company and copy and paste the whole thing on here into this new Walmart forecast one. So if you do that, so go up to the top for your company, copy and then paste it here. When you do that, you'll have all the data you need. And the forecast should update correctly. One thing I left out, and this is a capital IQ problem, is the dividends. I'll show you how to do that, and then you have to change the company name on the ticker page. So the capital IQ, let me just show you that one. If you're using capital IQ, you can bring dividends in pretty easily. If before you copy and paste, you look down at line 39, that's the capital IQ code for dividends. So if before you copy and paste, you get that data in. So the formula's there to bring it in. So if you have capital IQ, you can bring that in. For some reason, it didn't bring in dividends, but if you bring that line in, you'll have your dividends. Some of y'all won't be an issue because your company doesn't pay dividend for advance. We just typed it in, but if you wanted to get the actual numbers, you can bring in the actual numbers and that gets you dividends in there. You don't want to copy and paste first because then you lose all the formulas. So you may need to get this line. So look on Bloomberg paste values, line 39, you may need to get that for your company. You can put your ticker up in A1, get that amount. What I'd recommend you do, put your ticker in A1, get line 39 and put it into your file, and then take your file and paste it back if that works. So maybe I should put that in the instructions. First, get dividends for your company on Bloomberg paste values for line 39 by changing ticker in A1 to your company. Copy and paste dividends from line 39 to your files, line 39. Then you can copy and paste yours back. So I'm missing that one line. I think this is the only major issue I had, and I don't know why Capital IQ didn't bring that in before. So if you're going to use this file, now what you have to do is, and we talked about this before, but just to remind you, you're probably going to have a separate page just for your revenue forecast. People keep asking me how do I do that. There's just do it. I gave you 3 approaches: segment, factors. You can do geography. You can do your turnover ratio, number of stores, those kind of things. There's no rule on that, but you need to have something on your revenue here. And then you can then plug that forecast into the forecast here. Boy, I still have an issue with that. I don't know why it does that. What was it before? It's going, oh, it just didn't say +1. All right, I'll fix that. I'll have to save it one more time. All right, so I'll save it one more time so you'll have it. But once you have that, it's pretty straightforward. You can essentially just go down. Once you have your revenue forecast in there, you come down here, anything that's in green, these lines only apply to Walmart. They have nothing to do with you. So that's what I did to do Walmart's forecast, but you're not going to use them for your forecast. You're going to come up with your own forecast. So you'll just right here to do equal and go find your revenue forecast and put that in your forecast. Once you get that going, then it's the rest of the sheet's very, very straightforward. You just need to forecast all these things in green. And most of it's just going to be based on your history. Look at what the history has and then forecast something in there. Some things like miscellaneous items, I just plug in a number. Things like miscellaneous items, goodwill, just plug in a number. Interest expense. Yeah, that looks like another. Okay, I may have to fix one more thing. Golly. All right, I knew it's gonna be an issue when we switched from Capital IQ to Bloomberg. I'll look at that line. So that might have been your issue, Vance, when you were doing yours. Income tax. Just look at the history, accounts receivable all the way down. You just key those things in. Goodwill, I just typed in a flat number all the way across. Dividends percentage income. Dividends and stock repurchase a percentage of income. So it looks like I have just one last thing I got to fix there, and I'll work on fixing that. So not many of you have done your forecast, so you're probably not to this point anyway. So you don't have to use this forecast, but it is a fairly simple approach. If you don't use this forecast, you have to figure out some way. What some students do is just bring everything in Capital IQ and just forecast out the income statement, the balance sheet. The problem with that is you may not have an integrated, they may not be integrated. What you have in your income statement and cash flow statement might not make sense to what's in your balance sheet. So at least this integrates everything, but yeah, we'll have to fix this one last line. Boy, that bugs me. All right. So I'll keep saving this back as a new file. If you need help on your forecasts, then, set up some time with me, come by. I've met with probably 6 or 7 of y'all so far to get a decent forecast going. Some of you finished your forecast, and the ones I've seen have been really, really strong. So people that finished already, I don't know if they use this. Did you use this one, Dominic? You use your own. So there might be some errors in it from what I did, but hopefully you saw it when you're going down. Yeah, it's on the interest expense. Probably if you typed a negative number, it would have worked, but I just don't know. Yeah, it doesn't look correct because it's subtracting it, so it should be adding it. That's part of the issue I've had is when I try to look at every line. Sometimes Bloomberg brings in expenses as positive numbers. Sometimes they bring in as negative numbers. Sometimes Capital IQ brings in expenses as negative. Sometimes as positive, and so I don't catch every single one of them. So I'll try to get that working better. On the cash flow statement, Bloomberg's real consistent. If it's a cash outflow that's negative, a cash inflow is positive, but they're not always consistent on expenses, and neither is Capital IQ. So I got one last fix I got to do on that one. I think it's really just a matter of changing the plus sign to a minus sign. I think that's all I got to do, but we'll see if that. And Vance, you may have to do that on yours. So that probably fixed it, but we'll see. I'll check it one last time. All right. So what I want to do, we're getting to the end of the semester, so we've got the technical analysis is pretty straightforward. I'll cover that, start tonight and maybe finish it on Thursday. And then all we got is the exec summary. So I'm thinking I'm making Tuesday night a work night, so I can set up individual times with y'all and get some of y'all caught up. Some people are really far behind, so let that just be a catch-up time. I won't have any sector meetings, so essentially I'll be here from 5 to 9. So that's 4 hours. So it'd be a good chance if you're behind, it'd be a good chance to come catch up, or if you have lost a lot of points on a certain place, you need help on that. So I was thinking using next Tuesday as a catch-up time, not have class, but have spend time where I'll meet with y'all one-on-one and get you as caught up as you can. So if you're interested in that, any slot from 5 to 9, just email me and pick the time and we'll set it up. If you're not going to be on campus, then set up a Zoom session. We can do it by Zoom. I think that's a better use of time than doing the portfolio management side, because y'all are so focused on on the paper, you probably wouldn't be paying as close of attention on that. Is that all right? Everybody understand that? Works? All right. And then the last thing I want to do, it's crazy that I try to do this stuff in class, but I do want to try something. So I'm scared if I hit enter. Sheet one. Right. So I want to show you, this is the model for paper 7. So you've got 2 models and 1 extra analysis due on paper 7. So I want to try this. It's going to be kind of dangerous, but I want to see if we can get this data using capital IQ. So I want y'all to learn capital IQ. I think I'm learning it, but I haven't gotten 100% there. But I want to see if we can get this in the capital IQ. So y'all, where are y'all on capital IQ, or on a scale of 1 to 10? Any 10s here? I had one student do the capital IQ certification. It's set up for capital IQ Pro. We don't have capital IQ Pro, but he said he got through all of it. And he just had a couple of questions he couldn't do because of Pro, but he still got the certification. So if you want to do that certification, you get it on your resume, you can certainly do that. So let's think about capital IQ. It has this information. Like gross margin might be a good one to do. These are Bloomberg tickers. Capital IQ doesn't use Bloomberg tickers. So where can you get your tickers? Well, if you remember back in that Walmart file I gave you, that very first one, there's a file that says Russell 3000 pace values, and there's 2 columns of tickers in there. There's the Bloomberg ticker and there's the capital IQ ticker. So I set it up. I used the link function to count and say take everything out. That's the US equity, and just leaving the tickers. So these tickers work. So if you find the companies you want, let's say you want to do all consumer companies, or you want to do all technology companies, you just sort by column E, and then you'll have all of your tickers. So here I'm doing consumer staples, which is column C. And then it takes forever because capital IQ takes forever. So you get those stickers. So you have those stickers. If you need the formula for how to get the ticker from Bloomberg, there I have it saved in a file. I can't remember exactly how to do it. You have to essentially, the advantage you have, I had to go on Google to do this. So it's actually a pretty cool function. What it does is, we don't know how many letters are in the ticker. Sometimes it's 1, like Ford or Macy's. Sometimes it's 4. I think I've even seen some that are 5. Isn't Google 5? GOOGL. Some are 5. I don't know how much further we go than 5. But we do know that the last part of it's always the same length, UW equity. And so there's a function where you can say, hey, go to this position from the end, and then delete everything after that and take the previous. So there's a way to get that. And that's what I did here. You don't see the formula because I pasted his values. All right, sorry, I got the wrong. So column D actually. So capital IQ uses this function. You have to be a little careful, like Vance and Tamer, when you have a non-US company, you gotta be real careful on those. So capital IQ does have other letters after its ticker. You don't need it if it's a US company. If it's a non-US company, you might need it. You got to be real careful. So here's my consumer staples and consumer discretionary. I still don't know why. I did column D. Sorry, guys, I'm talking and y'all should stop me next time. All right, so I get my consumer stocks. Here's discretionary and stables. So get your tickers. And put them into the model. The company name is probably in Capital IQ, I would guess. We could try it, but I'm not going to do it right now. So let's try one of these. So let's look at this formula so we can get used to this formula so you kind of know what Capital IQ is doing. So this is the formula we need. Capital IQ, CIQ. J56 is the ticker. So remember that ticker first, just like Bloomberg. K54 is the account, just like Bloomberg. That's no issue. B1 is, I think, a date or something. B1 is the year, full year 0, which means the current year. I think that's probably the problem with y'all have a Costco because it wasn't quite there. And then these last two that I don't understand. Maybe Dominic, you figured out these last two. I'm not really sure what to do with these last two. So I just put them in there. US dollar, obviously, but this date, I'm not real sure what that date means. So I put U2, which is the current date today. I guess that's how it knows what Y0 is. I'm not real sure. And then there's 3 commas. So there's other stuff we could put in there that I'm not putting in there. I'm not sure exactly what those things are. And then U1 is US dollars. So we got ticker, account, the date or the year, current year, and then today's date and the US dollars. I'm going to bring today's date in US dollars over to this file. So we have those in there, and you can see today's date, the way they have it set up. CIQ, get date, IQ today. I knew that I did that because that's what the video said to do. I'm sure there's an easier way to do it. And in US dollars, you just type that in. And then you need the format for the dates. So I'm just going to copy this over. I'm not sure. Well, I'll tell you what, we're just going to copy the first one over. And let's see if we can do it. I don't have great confidence I'll get it right the first time. We're going to try it. So equal, someone tell me, first 3 letters, CIQ, then what? Ticker, lock in the column, then what? The account, that's not going to work. We can look that up, but we'll look it up. Then what? The year, all right? Is that right? Then what? The day, comma, 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 US dollars. Always going to, obviously, going to give me an error message, but let's find it. So we got Capital IQ, formula builder. We're looking for asset turnover. Yeah, it's not letting me in. Please close. Have y'all been having this trouble? Please close all other Capital IQ forms before proceeding. Yeah, it won't let me out. I don't know how to. Sorry. Well, we may not be able to do it. All right, well, so there's the format. You've got to get a capital IQ working on your machine, and then you would go find this account by doing formula builder and finding asset turnover and bring that in. So you should be able to create a model like this from home if you don't have access to Bloomberg. So what kind of accounts would you bring over? So when I'm looking at screening, I want something on revenue and turnover. So I like asset turnover. I also like asset turnover and improvement. So here you just bring in the latest. So if you do that formula exactly how we're showing, it's just going to bring in the latest years. And then what I'd like to do here is this year minus 3 years ago. What I'm looking for, what are those firms whose asset turnover not only is it's good, but it's getting better. That's a very easy thing to do. So you just have to bring in 2 columns of this stuff. And then I like to bring in sales growth. Bloomberg has that. Bloomberg has an account that has 3-year sales growth. It's just the CAGR of sales growth. I don't think Capital IQ does. So for Capital IQ, what would you have to do? You'd have to bring in this year's sales divided by, I don't know, 4 years ago. Sales raised to the 1/3 minus 1. You'd have to bring in 2 years of sales, unless Cap IQ has a 3-year sales growth. I don't think they do have stuff like that. I think you have to calculate those things yourself. You want to bring in something on margins. I always bring in gross and EBITDA. You might try operating. I'm not sure their definition of operating margin. It's often real close to EBITDA margin, but I would bring in those 3 margins. You might do the exact same thing here. You do EBITDA margin improvement this year minus prior year. Be real careful doing gross rates on a number that can be negative. That can look really bad. So be real careful. I always subtract. On asset turnover, I subtract, but especially on margin, because it could be negative 5% this year and it was 4%, or negative 4% or whatever. You want to know that it's a negative. So if you just subtract, you can see that it got worse. And that's really what I'm looking for. Did it get worse? So be real careful when you're dividing. The advantage of EBITDA margin, let me put the word margin in there. Is that you're always dividing by revenue, and revenues, except for really strange companies, can't be negative. So you don't have to worry about a positive over a negative number, or a negative number or a positive number. You can't tell which. So hopefully your denominator is always revenue, is always positive. So if you're comparing one year to another and it can be a negative number, make sure you don't divide. Make sure you're only subtracting so that you can tell it either got more negative or got less negative, which is still kind of an improvement. So you might do the same thing with operating margin. Just see what your model likes. We've discovered that the model tends to like operating margin better than EBITDA margin, even though operating margin is not that well defined. You want something on return on invested capital. So here you can do ROE, or return on invested capital. I like to do EVA, but I don't think Capital IQ has EVA spread, because it's a fairly subjective number. So you can do that in Bloomberg, but you can't do that Capital IQ. I'm pretty sure they have return on invested capital. I think I'm pretty sure I brought that in. Return on equity you have. You can do ROIC improvement as well. Just this year versus a few years ago. I don't know how many years you should go back. It kind of depends. I think COVID makes it kind of interesting. So you might say go back to 2019, so you get pre-COVID to today, and they at least improved since pre-COVID. Because if you go back to 2020, that might be such a horrible year. Everybody looks wonderful or whatever. I mean, especially if you're like United Airlines or something. So, so think about what your starting year is. And then you definitely need something on risk. So on risk, what we really like in Bloomberg is the 5-year probability of default, but they don't have that in CapIQ at all. So what are your standard risk numbers? Well, debt to EBITDA is a pretty important one, but now you have an issue with negative EBITDA. So what do you do? Negative EBITDA, debt to a negative number doesn't tell you anything. So you got to be really, really careful there. So how could you change this so that it's not a negative number? We could do debt to equity, but what's the problem with that? Equity can be negative as well. What's a number that you could use that's never negative? You could do debt to assets. So be real careful when you're doing numbers. The numerator, I mean, the denominator can be negative, the numerator can be negative, whatever, either can be negative. Be real careful. So if you can substitute a number like assets or revenues instead, you can certainly get a better, have less risk of a company giving you bad data because you're dividing by a negative number. Now, CapIQ might not have debt to assets, so you may have to bring in total debt and bring in assets. I do believe CapIQ has total debt. I do think they have that. If they don't, then you have to bring in short-term and long-term debts separately. So I think I remember seeing them having a total debt line, but you have to just look and see what's available. Anything else on risk, it gets a little tough. Now, if you've got some time to build this thing, one thing we've liked using in the past is to take the standard deviation of, say, 6 years earnings per share. You'd have to bring in 6 years of earnings per share and just calculate the standard deviation. You're just looking for volatility of the firm. You could certainly do something like that. Some people like to use WACC or beta, credit ratings. I don't think you can get any of that from CapIQ. WACC is a very subjective number. Bloomberg gives you a WACC, but who knows if you bring it the number. Beta is, I don't know. There's a chance CapIQ has beta, but I would doubt it. Has anyone tried getting beta from CapIQ? So if you do, it's just a regression beta from the last 5 years. I don't know if CapIQ has ratings. Have anyone tried to get credit ratings from CapIQ? You would think they would if Bloomberg does, since CapIQ is owned by Standard & Poor's. So you think they would have at least Standard & Poor's ratings. The problem with ratings is that they're not numbers. So if you use credit ratings, you got to convert it into a number. The way I do that is I get the historical default for each rating, and I just assign that number to it. So AAA, they made the default over 10 years, they made the default 0.6% of the time. I use 0.6 for AAA and just use those numbers. So if you have a AAA, then you get assigned a rating, but it's a little bit tough. So that one, these three are probably not possible in CapIQ. I don't think they have that data. And then you need your relative. So I'm doing consumer stocks, so EV, the sales is the most obvious. I have not tried bringing in relatives from CapIQ. Has anyone tried that? They should have PE ratios and EV to sales. I'm sure they do, because when you bring in that full Capital IQ report, they have a page for that. So they have that stuff available, so you can certainly do that. So you have two choices. You can come over to Bloomberg, or you have three choices. Come over to Bloomberg and build it on the Bloomberg machine. And I can certainly help you with that if you want to do that. You could try it from home on Capital IQ. If you're a heavy Bloomberg user, you might do it on Capital IQ just so you can get Capital IQ onto your resume. I think it'd be pretty impressive to say I built this model in both Bloomberg and Capital IQ. That's, to me, it's going to sound pretty impressive that you have some good background in both of them. And then your third option is I build it for you and you lose the 10% bonus. So those are your three choices. I hope you do one of the first two just because it saves me some time, but I can build these models pretty fast. They may not be the greatest models in the world. Right, so sorry we don't have Capital IQ. I'm gonna have to ask Capital IQ why we keep getting that error message. Now, one thing on the building these models that's extremely important is when you need two numbers like here. So here you want the current year, and here you want the prior year, but you need the prior year in order to get the difference. What you want to do is have off on the side, way off to the right, prior year. So you want to make sure your model, and if you look at our model, everything you're going to grade needs to be all together. So if I'm going to do the change in asset turnover, then way over here on the side somewhere, I'm going to have asset turnover 2019. And then here I'm going to do the change. Why is that? Because when you get to the ranking, you want everything you're ranking to be right next to each other, so you can copy the formulas over. You don't want, I got this, and then I got these three cells for calculations, and I got this all calculations, and you move off to the side. The way I actually build it, though, is I bring in all the data that I need, I put in the improvement, and the things I don't need, I'll just cut them and put them over to the side and get rid of the columns. So that, to me, is the way, I think that's the easiest way to do it. So you get it all set up like you want, and get rid of the stuff that you're not actually ranking. Because when you rank over here, you just want to be able to go column F, column G, column H. Otherwise, you got a mess on your hand setting up the model. And then what you're going to do is you're going to rank each of these. So if you look back at the sheet, there's our companies. I don't have the company name set up. I've got what I'm ranking. And then I have the ranking. And you notice in the ranking, I reference back to the title. I don't type it again. I reference back to the title. Why do I do that? Well, let's say you tried operating margin, it just didn't work very well. All you got to do is change that to EBITDA margin, and everything updates, including your title, so you don't have to keep editing back and forth. So everything I'm ranking is over here. And y'all understand the ranking, comma 1 versus comma 0. Y'all remember that? Comma 0 means what rank will the highest sales growth get? With comma 0, be number 1. With comma 1, what will it be? Be very, very last place. So comma 0 means a high number is good. Comma 1 means a high number is bad. So just remember that, very, very important. So here I got working capital, change to revenue. So how did I do that one? Now here, I don't think Capital IQ has that. But Bloomberg has a change in working cap. So I just took that, took a percentage of revenue, and that gave me a ratio. So that may not be possible. You could calculate this in Capital IQ. You could bring in inventory, accounts receivables, accounts payables. You could take that, plus minus, your receivables plus your inventories minus accounts payable. Do that for 1 year. Go back 3 years, do it for another year, take the difference and divide that by revenue. That could be your ratio. Their higher would be worse, because remember, a negative number is good, a positive number is bad. So higher would be worse to use comma 1. So I rank all of these all the way over. And then when you get to your relative, again, we use comma 0. Why? Because we want our most expensive company to be number 1, because we're hoping that's going to somewhat line up with our best company that's number 1. We want to see number 1, number 2, number 3. If we have a perfect model, everything be ranked exactly in order. So we're essentially using these rankings to try to guess or try to forecast the valuation ranking. So I hope one of y'all might try to do this in Kappa IQ. I think it's really, really impressive. I'll try it if I can ever get a machine to work. The ones down in the Bloom and the FSC are working. How many of y'all getting Kappa IQ to work at home? Is it working pretty well, consistently? It's what?
Mine's fast.
It's fast. Yeah, it takes a while sometimes to recalculate everything if you have a lot of companies in it. Now today I did Bloomberg. I'm actually going to show you this chart. I'll show you what I did. I did in Bloomberg and it was really fast. I might have to try it in Kappa IQ, see if I can get it to work. It was 3,000 companies and probably 30 something columns of data. And it came in pretty fast. I was worried I was going to get the NA limit that Bloomberg gives you if you bring in too much data, but I didn't get that. So it must not have been too much. So, all right. Let me save this a different name and bring it up again. All right. So your goal is to get a good looking chart like that. That's actually a pretty horrible looking chart. They're way too spread out. So I definitely need a lot more data. And then you mark your company. Here I got Domino's. I've got some other companies down here. So it's not too impressive. I've shown these at conferences. I showed one of these at a conference, a Bloomberg conference, a bunch of other professors, and they were just like shocked because most of them don't use Bloomberg. So it's there's a lot of colleges. I mean, you've got an advantage that you're using this stuff. There's a lot of colleges that they have Bloomberg, but the professors don't use it. That's not their source of data. I see Dr. Baynot down there using Bloomberg. So we have a few professors that have discovered and are using it, but they use these other databases. So if the professors don't use it, that means their students are generally not using it. So I think there's a lot of major universities that don't use it much. Now I saw the lady from Tennessee and they're definitely using it. They got a pretty wild setup, but I don't know what percentage there are. Some of y'all been to conferences where you talk to other students. I think some of y'all noticed that some of them never use any of this kind of stuff or have any background at all. So it does give you an advantage. The reason I know some schools don't do it well is I was at one conference and the professor presenting was going to show us how he uses Bloomberg in his class, and he had no clue what he was doing. The Bloomberg person kept coming up and grabbing his hands. No, you need to click on this and this and this. So I don't know. I don't think his TA or someone must have set it all up for him because he was completely lost. I felt sorry for the poor guy. So it does give you an advantage of other schools that the professors, they don't use it. And if they don't use it, they're not going to assign it. So essentially what they said is, hey, we have Bloomberg, y'all go use it if you like. And it's just it just doesn't get used much. So it does help get it on your resume. So now what you got to do is get Bloomberg and Capital IQ on your resume. You can do the Bloomberg Market Concepts. You can do the Capital IQ's certification. You can get those out of the way. The student that did it, a guy named Leo in my other class, he said it took him like 3 hours to get the Capital IQ. Has anyone else tried it? Bloomberg Market Concepts took at least 20 hours, I think, for me. Have any of y'all done that one? Yeah, it's quite a while. It's not quick, especially do every single one. So he was saying you can, and they give you a little certification. You don't need the certification. It's not like you put on your resume and they're going to say, hey, prove it to me. I mean, they're going to believe you if you put it on your resume. Don't lie about it if you didn't do it, just in case they do ask for proof. But learn most of these. So here's the Bloomberg function, BDP, ticker, and account. And then if you want the specific year, you got to put in more language, but it's just a matter of what I recommend is write the formula down somewhere for both of them and just know exactly what goes where. I don't know with all those commas, I don't know what those other things are and what distinction you can make. We had a trouble with Vance's that we brought in his company and we couldn't get the numbers to match. And I remembered, oh yeah, when you dump it from Capital IQ, it's going to bring it in Canadian dollars and we want it US dollars. And so I wasn't sure how to do that. So Vance, I don't know if you want to change this to Canadian dollars, I don't know what you type in there. So we'd have to figure that out. There must be a key for all the different currencies that you could bring in. And I don't know how precise it is. If it's, if you go back 5 years, are they going back 5 years for currencies? And are they taking the average currency for the year, taking the end of year currency? I mean, it's pretty complicated. So I'm not sure exactly what they're doing. All right, but get these formulas and learn them, write them down, take them with you so that you can use them. Even things like that, AQ underscore FY minus 0, you just have to learn those stuff so you can just type them off the top of your head and you know how to use them. I wish I could show you, but I can't show you, but these templates that they have, I don't have them loaded. I think, Anthony, you said you found some pretty cool ones. There's so many of them that it's a little overwhelming, but the titles look pretty descriptive. There's some pretty good templates in there for all different kinds of things. So that's another thing you might look at and just see what's available so you don't have to recreate something from scratch. A few things I haven't figured out from Capital IQ is how to bring in an industry like this. So I'll have to research that more. I don't know if you want to do the S&P 500 and have the sectors come in. If they have a way of dumping that in, that might be one of their templates. You just have to you have to see. But it's pretty impressive. And, once you leave UTSA, you no longer have access to this. You don't have access to the Bloomberg or to this. So this is your chance to really learn it. So I think it used to be 0% Capital IQ. Now it's more like 40, 50% Capital IQ, 50%. Most use Bloomberg and Capital IQ, but there's some that use only Capital IQ and not Bloomberg at all. So you really need to learn both of them. I'm glad to see a Capital IQ come along. Bloomberg really needed some good competition. And so I'm glad someone finally did that. But it does make a difference. Goldman Sachs said they liked hiring our students because they knew Bloomberg a lot better than other schools. So it does stand out. All right. So what are y'all planning on doing? Build your own model? Have me build your model? Capital IQ, Bloomberg, what is sense? Because it's gonna get close. So you're not thinking about it because you're still doing papers. You're gonna do Bloomberg? I mean, you could do both. That's essentially what I did with the Walmart file this time. Is I did both. I used Capital IQ for everything I could do, and then Bloomberg for the stuff I couldn't get out. Capital IQ. You could use them both. You don't want to put something on your resume if you just went through the training modules. You want to put something on your resume where you actually built the model. It just sounds more impressive. Have built models using both Bloomberg and Capital IQ data. I know the formula as well. I understand how it works. That's the kind of thing you want to get on the resume. All right. Let me show you something I built today in Bloomberg. So I brought in 2,967, so almost 3,000 companies. And I brought in 72 columns of data. You can do the math on that. I brought in 214,000 pieces of data. Here's the Bloomberg function. Y'all know that function. Here, this is the function. So BDP, the ticker, the account, I want year. So I tell it I want year. There's the year. Then you want an annual. And why did I divide by 1? So this is a trick in Bloomberg that I learned. The Bloomberg technician showed us this. I highly recommend this. What happens with Bloomberg is sometimes they give you NA, but if you use the if error function, it doesn't recognize that NA as an error. What the Bloomberg people said is bring in your formula and divide by 1, because if you take the NA and divide by 1, you will get an error. So what am I telling Bloomberg to do? What is the if error function? Do y'all remember that? You tell it to do that unless it's an error, otherwise do that. So I'm telling it, if I get an error, give me a 0, otherwise give me that number. So I'm doing BDP. I don't know what this first part of this stuff is, but BDP, the ticker for each one of these. I deleted everything down below just to save my file. So if I want to update this in Bloomberg, it's all 0 now because they're all errors because I'm not in Bloomberg. I just copy all of that down. I'm not going to do it, but I copy all that down and now I got all my data. So that's another trick. So I copied and pasted his value. So I have the data, but I have the formula. I didn't want to delete all the formulas because I don't have to recreate it from scratch. So I have the formulas and then I've got the data right here. So yeah, it's a lot of data. So 214,000 pieces of data, but it came in fast. So this is what I found. So this is the question I wanted to ask is the buyback yield. So I went in, I got stock repurchases, I got dividends, and then I divided it by their market cap. So here's the dividend yield. Very, very low going in the dot-com era. Started building back up, got back up to 1%. And so the dividend yield has risen back up to about 1.4%. The current dividend yield in the S&P 500 is like 1.6 because the stock market's dropped, but it's about the same. Here's the repurchase. So the repurchase you can see was less than 0.2%. Actually got above the dividend yield. 2008 went negative. There was more stock issuance. Then it started building again, much more volatile than dividends. Got up, that's 0.8 right there. That's 0.8. So you can see it's getting back to 0.8, got up to 1.2%, got up to, I'm sorry, it's the blue number. So got up to 0.8, jumped to 1.4 in 2018, 2019. In 2020, it didn't go negative. So it wasn't as bad as 2008, but it dropped back down to 0.6. And then this year, dividend yield and stock buyback is about the same. The article suggested the 1 to 1.5% range, but that was a few years ago. I think you could easily add 1% buyback yield to your paper 4 or paper 3 when you're doing the stock market. It seems logical. So just to make it clear, why do we do the buyback yield? So the expected return on stocks equals the dividend yield plus expected earnings growth. But the key is that earnings growth is not earnings, it's actually EPS growth, because that's what you're getting as a stockholder. So stock buybacks don't increase earnings, but stock buybacks definitely increase earnings per share. And so that's why you want to add that in there to get that extra kick in your growth in earnings per share, because the number of shares is going to fall. So your earnings per share is going to grow up grow as they buy more of their stock back. So I would recommend sticking 1% buyback in there. Now, what could you do? You could try with and without and see which gives you the better answer. You can do some cheating in this class. As we're going through the process, we're not actually trying to do a perfect evaluation because you don't have 50 hours a week to do that. So I'm perfectly fine where you write it up with the buyback yield and then you don't like the answer, so you take it back out. It works. I know all college students do that. I actually think a lot of professionals do that as well. They don't want to go to their boss and say, hey, I think this stock's worth $300. It's currently trading for $70. People don't want to do that. It just sounds stupid. That may be perfectly true and fine. But most people say, oh, you know what? My growth rate's off by 0.5%. Oh, yeah, that looks a lot. That's we rationalize in because we do trust the market quite significantly. And it's hard to convince your boss that you're that much smarter than the market. They're off by a factor of 200%. That's kind of bold to be able to say that. All right, so you could put this chart into your paper if you like. I'll put it out there on I'll put the Excel file out there in case you want to use it. It is the Russell 3000. It's not the S&P 500. I probably should go back and do this just for the S&P 500 because that's officially, what we're actually forecasting. I'm not sure if it'd make a big difference. It might be higher with the S&P 500 because it's bigger companies that might be doing more buyback. So I might redo this with the S&P 500 and see if it gives me a radically different answers. So I'll definitely put that out there for you.
So that chart saying that more firms are doing stock buyback.
Well, not only that doing more, but the last few years actually doing more of that than paying dividends. It got up there in 2007 where they were. You look like the trend here was very small and then suddenly a shot up and then you had the crisis, but then building back. Now, if I did this by industry, I'm sure there's some industries are much bigger in the stock buybacks than others, but you don't really care because we're doing the market's return. We're not doing your stock's returns. So the fact that you're in an industry that's not doing buybacks really doesn't influence what you're doing for the market risk premium because that's the whole stock market. And these are sizable numbers. I mean, just the fact that they're doing more buybacks than stock repurchases, than dividends is a pretty, because remember, most of our history, this blue bar was below the line. Most of our history in the US, they were issuing more stock than they're buying back. So the last 2 decades has really been an unusual period of time. Now, the question is what is this doing to their leverage? Are they becoming riskier and riskier and riskier? So maybe they need a higher expected return because they're more levered now because they bought all this stock back, especially if your net worth's negative. I still haven't figured out how to handle that. Yeah, I can't remember ever having a conversation in my college courses about firms buying more of their stock back than their net worth. I'm pretty sure if I'd asked that question to a finance professor, they'd say, oh, that would never happen. No firm would ever do that. And it's happening all the time now. So it's unusual. All right, so that's a pretty good chart. If you don't like the chart, you can change the colors or whatever, but I'll get you the chart out there so you can at least have access to it. All right. So you got that one, and then you have just a quick reminder. The relative value chart. Now on this one, this is the second one. So you have to do the ranking model, and then here the relative value. So this one, you have to do this on a Bloomberg machine. You don't have access to Bloomberg, you just can't get here. Let me know, I'll build the file for you and send it to you. It only takes a few seconds to actually build it, but you need to build graphs off of this chart for your company. So you put your company's ticker in there. Put your company's ticker in there. And you put your industry ticker in there. So you're comparing to your industries. I got a list of the industries. Sector tickers right here. So you have all your sector tickers. It will bring in the PE ratio, EV to sales, price to book, EV to EBITDA for your company, for your company's industry, and for the S&P 500. Just get all that data in, put it as pace values, and then the output is where you're going to do your graphs. And again, remember the output is you're doing your PE ratio divided by the industry's PE ratio, your PE ratio divided by the S&Ps all the way across. I highly recommend on this paper, Bond's paper last year on Costco, he followed this format really precisely. So you could just have his paper open to see how he wrote about it. He did it exactly how I did. I showed it in class. So if you forgot the class discussion, you can do that. But then create a graph of some kind. The graph you create is going to depend on how the data looks. So if you have some point that just goes crazy, and some of y'all will, some of y'all have stocks whose PE ratios goes to 400 for like 6 quarters. This doesn't work. You'd have to take, you have to remember how last time I just selected that and just hit delete, just took them out of the graph entirely. You can almost not even notice it. Or you start a different period of time. If the first few years are really messy, start a different period of time. It is possible that your dates might skip, because if their earnings went negative, they don't have a PE ratio. So Bloomberg only brings in when they have a PE ratio. So you might jump from 2008 to 2010 because they had some negative earnings. So the chart's going to be a little bit messy anyway. You might add a median in here. So here it's just looking at the industry. So you might add a median line in there so you can tell where they are. So you want to show at least 2 of them. So if you're doing tech, you might do the PE ratio and the EV to EBITDA. If you're doing retail, do the PE ratio and EV to revenue. If you're doing heavy capital, do PE ratio and the price to book. You know, pick 2 of them, show where your firm is. You do quote these numbers up at the top. We talked about how to do that last time. Walmart is trading 10% rich to consumer staple stocks. Historically, it's traded about 6% rich, so it's trading about 4% richer than its history. That's the kind of comment you're going to make here. I think Walmart may be trading rich, not because the stock is expensive, but just because they've proven themselves to be a really good defensive, more defensive stock than anyone would have imagined. And so that may be it. They are trading cheap to the stock market, but that's expected as well because of tech stocks have been taking off so much, become pretty rich. So anything that's not a tech stock is going to look cheap on that basis. So you need to build some graphs out of here. But follow Bond's paper is a great example. Now, what else can you do with this? You do have their historical PE ratios, and that might give you some sense of what's kind of a normal PE ratio for this company. And that'll help you with the last part of paper 7. So the last part of paper 7, I might make a video of this one just to help. But you're going to bring in your dividend forecast, probably for 5 years. Your EPS forecast, probably for here. So you have 1, 2, 3, 4, 5, 6 numbers. You got your KE, and you have your target PE. So that's all the data you need in order to value your company. You're going to take the present value for the dividends. You're going to take your target PE times your earnings per share at 2026, take the present value of that, and that gives you one last valuation to use in your model. You can run base, best, and worst here by changing either your KE or your target PE or something if you want to have 3 scenarios so you have something to fit into your football chart from here. But those are the 3 things required on paper 7. So I might this weekend do just a video just on this because my dividends weren't working on the Walmart one. So I'll bring it up now that we have I think hopefully a fixed forecast model. Let's see if we have our dividends in there. It's going the wrong direction. So I gotta fix one more thing. Boy. That's the downside of me learning capital IQ. I still haven't learned it. So I still gotta work on that a little bit. All right. And then the end of paper 7. The very end of paper 7, this is what where the football chart goes. So you have your 3 models on paper 6. You remember that? So your dividend discount model, capitalized earnings model, age model, proprietary quantitative model, whatever you're using, free cash flow model. You have your relative value charts and your target PE values. So you just bring all those together in one big chart at the very, very end. And then you have a recommendation buy or sell. That brings up the end of paper 7. So essentially you can use the end of paper 7 to bring together everything you've done in paper 6 and 7 all into one final summary using a football chart. And I can't remember if I know Bond did that, so we could probably look at Bond's paper. So his paper is Costco. All right, so he has a 52-week price, which you can put in if you like, the dividend discount model, H model, cap earnings, target PE. He didn't do scenarios on that, but you could. He doesn't have the PE ratios, so what I would recommend on this one is if you have richness or cheapness, you know, you can find a way to summarize this and try to get a sense of the downside versus the upside on richness and cheapness. I think you can summarize this in the football chart. So if they range in cheapness from negative 15% to richness of positive 15%, you can apply that to the current price and get somewhat of a range. So you can definitely use these numbers. He didn't put anything in his paper from that, but you could certainly do that. But he just put a comment, ranking model trading rich. That's on the ranking model trading rich to peers and S&P 500. But you could take the historical PE ratios and do that. And then his football chart, he put it in the very, very beginning. I would put it in paper 7 at the very, very end, make this be the last thing in paper 7. So cap earnings, H model, dividend discount model, and then he put the 52-week price. He doesn't have anything in there on the target PE model. So you want to find something to summarize all of paper 6 and 7. So he didn't do quite as much as I was hoping. Let me see if I can help you with this. So I just brought the output over and just summarize it. Just looking at that, what would you say about Walmart? This is like a stock that's trading rich and trading cheap. It's trading very, very cheap to the market, isn't it? It's trading a little bit cheap to its industry, except for on that one. So could you convert these into a football chart to get a sense of where they are? So if the current price is, say, current price is 160. Oh, I'm going the wrong way. Excuse me. You're trading cheap, so. So if you think they're trading 13% cheap and the current price is 160, what is your value for this stock? Here's your, yeah, I think that's correct. But anyway, so you think should be trading at 185.22 to 216.02. I took the median. So that would be an easy way to do this. This is what my models are showing me. Walmart should be trading the 185 to 216 range based on where it is versus this industry and versus the market. I mean, right, there are probably other ways you can do it, but some way of just summarizing this up. But it's pretty clear Walmart's trading cheap to its history. So you might say relative value versus history. You think it should be somewhere between 185.22 and 216.02 or something like that. So I think you can get this file into your football chart. I wish I had another company I could show you, because I don't. Some of you on the tech side, you probably have all positive numbers there, just trading, especially versus the S&P 500, just because you're what's been running. All right. So what do we have left? So you've got to get papers 5 and 6 done. 5 and 6, you have the video. Everybody see the video? It should be pretty straightforward, I think. Just follow through on that. Paper 7, you got 3 things to do there. You see how those work. I might do a video for you for paper 7 this weekend. We'll see. So what do we have left? We have the technical analysis, and we have the exec summary. So we're pretty close to the end. We're getting real close to the end. Technical analysis is by far the easiest paper and the shortest. I do recommend that you do technical analysis on the Bloomberg machine, just because the resources are they have a really good technical analysis. You just type the word tech, T-E-C-H. It brings up everything you need in that one place. You can do that entire paper just sitting at the Bloomberg machine. Not only, well, I'll show you, I'll bring in some charts, but not only does it define each of the technicals, but when you click on it, it brings up all the graphs you need. So you can take all the graphs from Bloomberg and just plug them into your paper, and then it's real simple. You got to do 3 technicals. So only need 3. You need to define them, how they measure, show your firm's chart, and discuss what the technical is telling you about your chart. Real simple. So that's why it's the easiest. What I recommend you do is you got to do 3. You have to do a moving average and 2 others. So I want everybody to do a moving average. Moving average, there's different ways you can do moving average, but I'll show you the different approaches. But a moving average chart, and then 2 others. And on the 2 others, what I recommend is find one that just has the wildest name that sounds really crazy, and put that in your paper so you have something. I'll show you some of the crazier ones. Something that when you're talking to the HR person, they're going to think you're a genius. I mean, you probably are a genius, but you make them think that even more. So there are a few of them that are pretty wild. Most of them are oscillators or moving averages with adjustments or ranges around, standard deviation ranges. Most of them are not very complicated mathematics. It's just they have wild names because they're named after the person who came up with them, and some of them are not even pronounceable because they're really tough names. And then executive summary, this is where I'm going to show you some examples, but you want to be sell side professional looking as much as possible. I'll give you several examples of what that looks like. So you can get that first page to look as much like a sell side report. Maybe I'll show Colin's team's paper from last time. Y'all did a pretty good job of making it look sell side-ish at the beginning. So that's all we're up to. When is paper 5 and 6 due? When? November 23rd. That's the day before Thanksgiving. Right. No, Thanksgiving's Thursday, isn't it? 24th. So I mean, if you're a few days late, I'm gonna be grading papers the whole weekend. In between turkey and whatever. I don't really like turkey, so between mac and cheese, I'll be grading papers. So yeah, these next 2 weeks is a real good catch-up week. I want all y'all to get caught up and fix your papers from before you get the stress at the end of the semester, get this much behind you. So I'm going to give you next Tuesday, and then I'll also be around next Wednesday. So if y'all want special time, I don't mind coming up here. We can get y'all caught up. If you're struggling, this is the time to do it. Especially on the forecast. If you sit down with the forecast, I can usually get you pretty far in the forecast. Once I get it fixed, I keep finding errors in the model. And then paper 7 has got some work to it, so you need to get onto that. But most of paper 7 is getting the Excel done so that you can get that home, because paper 7, for the most part, except for that third thing, the third thing is a little bit messy, but except for that third thing, it's really just describing what you see in the Excel. So it's not all that complex in getting your charts into the paper. And then the last 2 papers are a lot more straightforward. All right, so we're getting close. All right, any questions on anything? So email me if you want a special time next Tuesday or Wednesday. Tuesday 5 to 7 or 5 to 9. Wednesday anytime in the afternoon. I can work something out. So next Tuesday we won't have class, but I'll meet with as many of you I want to. Sunday, Monday. If you want to Zoom with me, we can. I'm going to be pretty busy. My church, I'm the treasurer, and we had a ransomware attack. And the poor lady who's our bookkeeper, everything she knows about accounting, she learned from me. So she's in tears, the poor lady. So we're having to recreate everything from scratch. So I promised her time on Monday, and usually I plan an hour and it goes 6 or 7 hours. So, but if you want to try that, but Tuesday up here, Wednesday, Zoom anytime. I won't be on campus on Wednesday unless you just absolutely need Bloomberg. I don't mind coming up here on a Wednesday if you're really desperate. But we got to get you caught up and get your papers going. On the forecast, I'm still struggling getting the forecast model. So I'm going to try this weekend to build a video of how you can use the Walmart forecast if you want to use that once you get your revenues built. And then how to do that last part of paper 7, which is the 5 years. So it's just so you have something to work from with that. That tends to be the 2 things people are struggling most with. Today, Anthony got most of his paper 7 done, and he's in good shape. And it actually worked pretty well for his company. Doesn't always. Now, he had a few places. I wish we could have shown them the before and after. He had a few places where it was off the charts, but it came to mind. We just took that, we sorted it by the relative PE, found the biggest ones, got rid of them, and resorted by date. So that's a real fast way to get those massive ones out. So if you need help, you got to email me, help me get you caught up as much as possible. If you need to rework papers 3, especially, or whatever, and you have questions on that, I would, if I were you, I'd try to get as much through paper 7 by the weekend after Thanksgiving as possible. And that gives you the last couple of weeks to fix papers and get those last 2 papers, which are really are the easiest of the 10 of the 9. I'll send out the email tomorrow or Friday on all of that. And I'll add, they're doing the instructor surveys or class surveys. If you do that, you get a 1% bonus. So, get that out of the way. It's pretty interesting on that. Students with the highest grade in the class always do the surveys. Students with the lowest grade in class never do the surveys. So it kind of makes me think that they're just so overwhelmed by the semester they can't even get a free 1 point. So, and the ones that have like, 99.7 average, oh, I did the survey. Okay, so you're 100.7. All right. I did update the buyback yield because I was really curious, thinking the S&P might actually have a slightly higher buyback yield because it's dominated by some of those massive tech companies. So here's the Russell I showed you last time. About 1.8%. I'm sorry, this is, no, this is, I'm sorry. This is the S&P 500. I forgot to change my title. For the S&P 500, it is higher. That's what I recognize. So remember the Russell, with the Russell, we were at like 1.4. For the S&P, it's more like 1.8. So you probably, I would go 1 to 1.5%. I don't think it's going to stay at these high levels because those were some pretty raucous years for tech, and they're definitely coming back. But I think you can definitely justify 1% adding on the yield. When you compare the two, you can definitely see these are just buyback yields. For the S&P, it's consistently higher than the Russell 3000. I doubt a lot of small companies buy their stock back. They probably don't do anything. They probably just cling on to every single piece of cash they have. So I'll put this file back out there again in case you want to use these charts, and hopefully I have the right title on this one. All right. So tonight we're going to have a more theoretical discussion on technical analysis. Probably haven't seen much technical analysis in undergraduate, you might guess. Probably 95% of PhD professors don't think it's worth being covered because they believe in the efficient market hypothesis. But you need to, it's used all the time. It's pretty common. So you need to have at least a basic understanding so you don't come completely blind into interviews. So everything we've done in this class has been fundamental analysis. So now we're going to do technical analysis. We did some relative value analysis as well. So technical analysis is using past data on prices or volumes to try to figure out where the stock's going next. Now, you've probably seen the efficient market hypothesis before. There's 3 versions of it: the weak form, the strong form, and I forget the 3 forms. But anyway, the weak form test, Dr. Fama in the 70s asked the question, does knowing past prices and their trends give you any advantage in predicting where the price is going next? And his answer was no. Now, how do you test that? I thought, to me, the best test he did was he created some stock charts, and then he created some random charts. And he gave the actual charts and the random charts to analysts, and they couldn't tell the difference. So if there's a pattern there, you should be able to tell the difference in randomness, wouldn't you think? There should be something there. And so that was kind of his big test. He said no. Now, there's other people out there. There's a couple books I do highly recommend. Andrew Lowe. Oh, that's not it. Andrew Lowe. There it is. This guy right here, Andrew W. Lowe, really nice guy. He's written several books. There's one on market efficiency. He's actually pretty famous. He went to a conference young in his career where he essentially proved the efficient market hypothesis was wrong. The guy who came up after him said, that's really nice, but obviously you have a flaw in your data. Go back and fix it because that can't be true. And then that guy went back and replicated Andrew Lowe's analysis and found that he was actually correct. So he had to apologize to him. But the efficient market hypothesis was such a mantra for the industry, you weren't allowed to question it. So they just assumed if he proved it wrong, it couldn't be because he was right. It could have been because he made a mistake. His hedge fund paper is interesting, a little technical. His adaptive market hypothesis is a really, really good one. It's interesting. He has, if you watch his MIT class, it's a really easy class. It's not that complicated. But then you read his when he had present to Congress, there's no way there's any member of Congress who had a clue what he had just said, because it was very, very, very technical. So he can go heavy, heavy technical. He's a very quantitative guy, and he can be down to earth. Very, very nice guy. I've met him a couple of times. He actually, I wanted to give his book away as a gift, and so I mailed it to him, and he signed it and sent it back. So he's kind of a nice guy. But here's his book on technical analysis. He won't let me open it for some reason. He goes way back. I mean, look at the title. He goes back to the advantages in trading. He talks about, I guess, in the Roman Empire or something, people on horses riding as fast as they can to say that what prices were doing behind them, kind of thing, just kind of crazy stuff. And his purpose of this book is not to tell you how to do technical analysis. His goal is to give you the economic rational reason for why it works. So it's a good book. If you want to use technical analysis or talk about it, it gives you the framework for why it should work. So it's a good book. It's a very easy read. Oh, I can't remember her name. Do I have it in the notes? I think I do. Yeah, I think this is it here. Let me find this one. Dalquist. I just cannot remember how to spell her name. Anyway, I remember Dalquist. I think she was probably gone by the time. So this Julie Dalquist, anybody ever heard of her? She's a UTSA professor. She probably left UTSA 5 or 6 years ago. She's the only one that taught technical analysis. I think UTSA has had that class on its books, but has almost never taught it. She's the last one to teach it. She wrote this book. This book, I couldn't make it through the whole thing. But the first few chapters I thought were really, really good. Because in the first few chapters, she and the other writer lay the good groundwork for why technical analysis could work, should work, could have some theoretical basis to it. After she gets past that, and I don't know how to get into the actual book here, it won't let me. But once you get past that, then it's chapter after chapter of strategies, technical strategies. And it gets really frustrating because she goes through the strategy, and then at the end of it, she says, but this doesn't work anymore. Let's go to the next strategy. And every single one of them. This doesn't work. You can see in the data, it stopped working. So that one's a bit frustrating, but very good book. I just couldn't take strategy after strategy. Some of them they're just mind numbing. But if you're going to be a technical analysis, you'd have to read a book like this in detail, know every single possible strategy there is out there, why it would work. But even better is Ned Davis research. We use this a lot at USAA. Great firm. They're very, very expensive. However, my understanding is on Twitter, if you find them on Twitter, I don't have a Twitter account. If you find them on Twitter, they have a lot of free things they provide on Twitter, a lot of charts that are really quite helpful. Really impressive firm. So you see these type of charts on their account. Very distinctive Ned Davis type of charts. And what a lot of their charts on technical analysis do is they show you all the history. They tell you what percentage of the time it worked, which to me was pretty good, and then how much it worked. So this one works 70% of the time, and the outperformance is 3%. This works 90% of the time, the outperformance is 0.5%, that kind of thing. Some of them are really, really exciting. And in 2009, they were all excited because they have 13 indicators of the bottom of markets. It's really hard to call the top of markets, but they call the bottom. They had 13 indicators, and the first time in their history, all 13 of them were saying buy. And so we started buying stocks again, and it hit it almost to the day. It was pretty remarkable. So they have some great charts, a lot of research. They may ask small cap versus large cap, US versus non-US. You can ask them, how do large cap stocks versus small cap stocks do when a Fed is tightening? That seems like a good piece of information to ask. How do growth stocks do versus value stocks? What I loved about them is you could ask that question. Say, can you run a chart, Fed funds versus growth versus value? About 2 hours later, they send you the chart. you look at it and they ask you, do you like the chart? And you say yes, and then it becomes a permanent part of your reporting. It's an amazing firm. They must have really great IT. This looks like, wow, I almost want to stop and just read this. So you get that for free. I don't know how much they cost because I never saw the bill. We were paying for it, but I never saw the bill. But I'm sure it's probably more than you want to spend. The reason I know it's pretty expensive is the guy who I took his place. He somehow finagled them into giving him a free account after he retired. And then I have lunch with him a few years later and said, yeah, they took it away. And that's when he showed me all the Twitter feeds. But you can get a lot of it off of Twitter, but he was kind of disappointed and he wasn't going to pay for it. So it must have been too expensive. It's not something like, if it had been $50 a month, he would have paid for it. So it must have been a much more than that because he wasn't even interested in it. I don't think it's as expensive as Bloomberg, but it's up there. So if you're interested in technical analysis, I would definitely get onto their site and read about it. Ned Davis is still around. The last I heard, he sold the firm. I don't want research. I just want Ned Davis. He sold the firm. Oh, there we go. How much does Ned Davis cost? Average fee for clients is $50,000. Okay, so yeah, it's a little more than I was thinking. I guess I should have looked at the bills when I was signing off on them. So Ned Davis, he's getting up there in age, but he started this firm, made millions. In my understanding, at least the last time I saw him, he sold the firm and he stayed working just as an analyst, just for the fun of it, just because he's kind of an obsessed person. He's a little bit of a strange fellow, but obsessed about data and numbers, but interesting guy. Technical analysis of long-term data series. And it's not just stocks, it can be bonds, it can be real estate, whatever he can get his hands on. He did the analysis. So that's a really good resource to have in your hip pocket. So there is some justification out there. There are some very impressive people out there saying technical analysis does make sense to do. It does provide power. Eugene Fama still doesn't believe that, but there are people. Dr. Lowe is a pretty impressive person to be on the support of technical analysis. So he says it was a waste of time. Most universities don't teach it at all, but there's been many tests since then. 58 showed positive results, 24 showed negative results. I think I got this out of Dr. Dalquist's book. So yeah, there is some indication, and Ned Davis has more than anybody else. So some people think technical analysis assumes markets aren't efficient. What Dahlquist's argument she makes is technical analysis works because markets are efficient. So her argument is investors are so fast at incorporating data that fundamental analysis, you have no hope, because once the data comes out, I mean, it's going to be in the price immediately. However, not everybody responds together. So she says technical analysis works because there's supply and demand imbalance. People react, but not equally. And what technical analysis is looking for signs of that imbalance between demand and supply that's going to correct itself. So it assumes markets are efficient, but not all people react at the same time. So so assume all information is priced in. Only to important unknown is the price itself, that determined by the supply and demand for the stock. The valuation process is so uncertain, fundamental analysis adds less value than watching the impact of supply and demand. So and y'all seen that, you're going to see that in paper 6. You can get almost any price you want to, can't you? Small changes in your assumption. It's just the nature of the beast. And she's saying, yeah, that's true. We're pretty uncertain of our valuations. So the only thing we don't know is how the buyers and sellers are going to line up. They contend it's a waste of time to do fundamental analysis. So they're kind of on the opposite. The art of technical analysis is identifying trend. That's a really key term here for technical analysis. Trend changes. So the purpose of technical analysis, you're trying to find the trend and you also want evidence that it's going to flip. So like in 2009, trying to figure out when we're hitting the bottom. I kind of knew we're hitting the bottom because my boss called and says, you know, I don't think we should be buying stocks. I'm getting really nervous. And it's like, okay, we're hitting bottom. That is a technical analysis. When headlines are saying it's horrible, it's going to get worse, that's probably when it's at its bottom. So try to get the trend changes at an early stage and to maintain investment position until the weighted evidence indicates the trend has reversed. So the big question is, it's timing versus risk. If you risk getting in too early, you got to risk losing a lot of money. But if you're too cautious, you lose a lot of the bounce back. If you look at 2009, man, the stock market, it shot back up really, really fast. So sometimes you don't have time to look back. In 2020, man, you remember that sharp V, you'd have to get onto the wave pretty fast. And so the argument is this is from Dalquist, technical analysis represents a rational choice. Do y'all know what a bounded rational investor is? So bounded by what? What if you had infinite time all day? You'd probably be a pretty good investor when you're bounded by time. You don't have enough time to do everything you want to do, but you're a rational investor. You're trying to make rational decisions. So given that you don't have all the time in the world, this is a rational choice for bounded rational investors. It can allow them to make reasonably well-informed decisions with relatively small amounts information processing costs. If it works. And the fact that something's worked in the past doesn't mean it's going to keep working in the future, because the supply and demand, those are individual investors. Something Dr. Lowe talks about in his adapted markets, really interesting, is that markets change the investors. So it changes the demand and supply people. So 2008, some people are in the market got completely out after 2008. So they're no longer in that demand supply. So it's a whole new group. So he says markets adapt, they change, they adjust to the information. And so the future is going to be slightly different because you have a different group of people in the mix. I would show you this one, but this guy is no longer exists. He came to USA and spoke to us. He worked for Wellington Capital Management, a well-known firm. He ran a stock fund that did nothing but technical analysis. We thought, wow, that's really interesting. It's really convincing. We never invested with them, and I'm so glad we didn't, because there's a good reason why it's out of business. The performance was horrendous. But anyway, there are people who do that. He was one of those high octane people who were just bouncing off the walls, but which kind of you might think a technical analyst would be. We do have technical analyst alums. Probably our best, most famous one is Will Jones up in Houston. I saw him this summer. I don't know if y'all know him. He's a famous UTSA grad. He runs a prop desk in Houston. He's a day trader. He's trading all day long, trading at 10 a.m., buying at 10 a.m., selling at 1 p.m. kind of stuff all day long. He seems to be doing well. He's married, he's got a kid, seems to be in a nice house. So he seems to be doing all right with it. And he's primarily a technical trader. All right, so what drives demand and supply? Well, it's human emotion and behavior. So there's some behavioral finance here. This is one of the reasons I argued at USA. I don't want to take a technical analysis because I'm not a psychiatrist. I'm not a sociologist. To do technical analysis, you got to understand somewhat about human behavior. People react to prices in ways that causes them to trade at certain times, and so you can somewhat trade off of that. Now, Dalquist argues we have these forces that are causing these supply demand imbalances, but we don't have to figure out what they are. We have no idea. There's no way we're going to figure out what they are. All we got to do is recognize the patterns and see if they happen again. So she's not saying you got to sit down and figure out who these people are and why they're doing that. She says there's an infinite number of explanations, so ignore the why and accept that prices provide information on supply and demand. Here's some Dr. Lowe. Supply and demand are driven by fear and greed. I mean, a good example is the retail investor. The retail investor hates to sell losses, so they hang on to the bitter end. And at the bitter end, they finally sell. That's when the institutional investor is buying. And so and there's indications like that. Small lot trades, have you ever heard of those? You look at small lot versus round lot trades. Small lot trades, those are the retail investors. Round lot, that's the institutional investors. You look at that imbalance. 2009 was a perfect example. Small lot trades were hitting record highs. Round lot trades were coming back strong. So the institutional investors were stepping back in. Retail investors were getting out at the absolute worst possible time. So it's not just supply and demand imbalances. It's who are the supply, who are the demand. We can actually look at that. One of my EMBA students was so mad about that. It says, you guys are like taking advantage of the retail investors. Yeah, they're stupid to be buying stocks anyway. If they want to indicate to us what they're doing. And what does Robinhood do with your data? Don't they sell it? Isn't that the reason they're free? They're trying to give information to someone who's going to take advantage of you. So she said these shifts from fear to greed, and Dr. Lowe, are predictable and repeatable. That's a pretty important contention. Humans move from extremes of optimism to pessimism. They sell their winners too fast. They hold their losers too long. Support levels may reflect the attitude. I was going to buy the stock. Next time it hits that price, I'm going to buy. So that's why round numbers tend to be support and resistance. So resistance level, I was going to sell the stock. Next time it hits that price, I'm going to sell. So those round numbers, which my idea, and I haven't studied this before, my idea, if you have a day with a high volume, you might want to look and see what that price is, because that might become a resistance support level later, because that means a lot of people have that price. You probably do this with your own stocks. You remember the price you bought it, don't you? And that becomes kind of an important point to your, at least to your ego and what you're going to do. Y'all know what resistance and support are? Support, it keeps hitting the same bottom or same corridor. Resistance, it hits on the upside. So if it hits a support, it should bounce up. It hits the resistance, it might bounce back down. There is Dow theory. Dow theory was Charles Dow. He never wrote Dow theories. So someone came after Dow and wrote down what he did. Who knows how close Dow theory is to what Dow actually did, but Charles Dow came up with this stuff. He said there's uptrends, there's a top, there's a downtrend, there's a bottom. You have retracements and consolidations. Consolidations just kind of goes sideways for a while. And then he said you got to be careful. There's primary trends, secondary trends, and noise. We're looking for the primary trends. And the primary trend is you have the institutional investors coming in. They're starting to make trades. There's a growing confidence. The middle investors are start trying to get in and try to make their bets. They're a little late. They feel like, you know, what is FOMO? Is that what it's called? FOMO, fear of missing out. So they start coming in. And then at the end, they were making money. So what did they do? Then they start borrowing money to invest. And then any small change in the price, they're done for because they're so levered. So debt comes in at the end, especially the retail investors, and that's when the cycle is going to end. So you can see institutional investor, large, but more retail investors, and the retail investors buying on margin with borrowed money. It's kind of the symbol. I don't know if y'all have ever heard of Minsky. I don't know how to spell it. Have y'all heard of Minsky moment? Let's see how we spell his name. I can't remember. Minsky moment. I spelled it right. Minsky. Have y'all seen this in another class? Oh, have you, Chad? Was it in my class? We might have talked about it. So, so he's just talking about why do we have these big bubbles and these big blowups, and it really has to do with leverage. It's that confidence, and confidence makes us borrow money to do things, which leverages up, and so then small changes in prices at the top just cause these incredible tipping points. Speculative activity reaches an extreme that is unsustainable, leading to rapid price. What happens at the extreme is the only way to leverage investors survive if prices keep going up. We saw that with real estate in 2008. I mean, it's ridiculous in 2008 or 2007, housing prices in California. It was just absolute insanity. What we used to do with housing prices is we compare housing prices to rental rates. And I looked at the history of that, and what I tried to do, I did this for one of my presentations to the exec council on economics, was instead of doing house prices or rental rates, I did housing prices to 5-star hotel rates. and it looked about normal to what rental rates used to be. Any of y'all paying 5-star hotel rental rates in your apartment? $800 a night, kind of. You may be paying less a month than Hope 5, but in California, the houses got so expensive, it would have been cheaper, rent wise, to just go into a 5-star hotel. So this is a good thing to have in your hip pocket. It certainly seems to explain some markets, especially at the extremes. The secondary trends, these fool us. We think we're on a trend. And we saw a lot of that in 2008. So, oh, it looks like he's coming back, and no, it goes down, it looks coming back. So 2008 was a great year for me because I knew I was retiring in 2009. It was real volatile at the beginning of the year, and I thought, I'm head of equities. My entire retirement, I'm about to retire, and my job is stressful, and now I'm watching my portfolio go out of place. So I went 100% to cash, and it was kind of luck for me that I was just too stressed out. But early in the year, I kind of assumed we're going to have one of these trendy markets. So I kept buying at the low and selling on the way down. And fortunately, the stress got to me. I went to cash. I was up like 16%, went to cash right at the right time. And then the trend didn't go anymore. Instead of doing this, it just went straight down. And that was pure luck. Just amazing, pure luck. But as I say, you remember my risk management class, I want to be smiling smiling when everyone's laughing and laughing when everybody's crying. So I was very relieved I didn't lose 30% of my money the year I was retiring. So this can fool us, or you might be able to take advantage of it if you think going to be trading that kind of trend. And then noise. That's what retail investors focus in on. Now, you might say primary trends. Oh, that's over months. Secondaries over weeks. Noise is over days, but no, all of these trends exist in all time periods. So we have Will Jones is our day trader. These primary, secondary, and noise trends exist in days. You see the same trends. In fact, it's really hard to tell the difference between a day pattern, a month pattern, and a year pattern. They look very, very, very similar. It's pretty remarkable. So what Charles Dow said was err on the side of being late rather than being wrong. Don't react too quickly. Don't get too excited. Be patient. So there's a Dow theory. A lot of these commercials you see on trading by our software, a lot of them are still Dow theory based. All right, so what are we looking for? So in your paper, you have to do 3 of them. And one of them will be a moving average related one. I'll actually show you what USAA did because my boss forced me to do technical analysis as much as I hated it. So I'll show you what we actually did, and then you have some others, and I'll show you some of those. So let's look at a moving average, and let's just do a simple moving average. So what a moving average is trying to capture is momentum. Does this stock have momentum? Cliff Asness, the famous hedge fund manager, his definition of momentum is the stock price is higher today than it was a year ago. And that's all momentum is. The stock is higher than it was. That seems awfully simple, but there is a tendency for stocks that are going up to keep going up until they don't. So let's try it. Have y'all calculated moving averages before, anybody? How hard is that to do? So you just go get, now you can do your moving average from Bloomberg, or you can build it yourself. I'm going to build it myself. I'm going to do the max, but you don't want to go back that far, but I'm still going to do the max. So here's Walmart stock. And all we need is the close. Don't use the adjusted close for this one. You use the actual close. The close looks really small, but that's probably because it has some stock splits. So the close is adjusted for stock splits, but it's not adjusted for dividends. So let's come down to the end. Maybe we'll go back. Let's go back to the end of 2019. That's probably too far, but we'll go back to the end of 2019. All right. So we're going to do a 200-day moving average. A 100-day moving average. and a 50. Some people do 20, some do 10. I've always thought if you really believe in it, you should do 199, because if 200 is really popular, everybody's looking at 200. So if you do 199, you'll be a day ahead of everybody else, and maybe you'll win. Who knows? But let's try the 200-day moving average. All you do is just equal average of the stock price. And there's your 200-day moving average. Can't get much simpler than that. 100-day equal average, 100 days, and then 50 days. And then you copy that down, and then you just graph this. And we'll see if this is too many lines. I mean, too much time. You put some dates in here. And then one thing you definitely have to do is change the axis. So let's start it at, say, 100. Go to 160. Yeah, that looks good. All right. That doesn't look way too much data. All right. So the blue is their actual stock price. The orange is the 200-day moving average. The gray is the 100. And then yellow is the 50. So if you look right there, that was a pretty big day. That must have been when they announced that that earnings problem and the inventory problem. Did y'all see the news this week? It's pretty interesting. Some of you are doing Target, I think, right? They're doing, so it's really interesting this week. So Walmart produced really great earnings, and their stock price zoomed, and then Target released earnings, and they missed by a mile, and their stock price tanked. And then Macy's released earnings, and they beat. So Walmart went up, Target fell like 10% or more. The day Target fell, Walmart went up 5%, and then Macy's released, and they went up 5 or 6%. And I was reading an article that it just sounds like the Macy's, Nordstrom's people are still buying expensive stuff. The Walmart people are still buying cheap stuff, and the Target people are going to Walmart. So there's some strange phenomenon going on. But that was probably when Walmart announced that they had some inventory issues, and and then they did really well, released their earnings, and then reaction to Target. So what is this telling you? So we look at the numbers themselves. There's the 200-day, 100, 50-day. The current price is 148. It's greater than all three of them, so that's good. So they got strong momentum. However, the 50-day is lower than the 200-day, and the 100-day is lower than both of them. So what do you want with real momentum? So this is, I'll tell you, this is no longer inside information because the CEO that ordered us to do this doesn't work there anymore. But he said, buy when 50 is greater than 100. It's greater than the 200. So when current price is greater than the 50, when the 50 is greater than the 100, and when the 100 is greater than the 200, that's when you buy. How do we come up with that? Well, our technical analyst person, that's what his data showed. Does it work? I don't think this works all that well. The reason I don't is kind of hilarious. I'm glad I'm putting all this on video. I doubt the problem is previous CEOs watching this, but I remember him in front of exec council explaining this to them with the chart, and he was saying, it's so obvious, look how it works, and then none of the points were working. He says, well, never mind that. I mean, it works. And it's, yeah, it kind of destroyed his own argument, but, and then I took so much flack because I was having to actually execute this. I was kind of glad when he retired or whatever he did. All right. So Walmart has pretty good momentum, but the 100-day hasn't quite caught up, and that's because of that huge sell-off here. So if you look here, you're trying to find a good buy point. So we want the yellow, the highest. So right there would have been a buy point. Y'all see why that's a buy point? So 200, 150. Why wouldn't you buy right here? Because the actual price is below. So when do you know exactly when to buy? All four things have to be there. Where is all four things? When you get all four things, it's right on that point right there. Once you hit that point, then you would buy. Now, when would you sell? There's a point you might sell and then buy right back. You would sell there, buy back, sell. Right here, you probably would stay out because you notice the 50 crosses the 100. So you would stay out here. When do you come back in? Not here, right? What's the problem here? You'll see what's
below the 200.
50's below, so you wouldn't buy there. You missed out on all of that. Now you're getting nervous. There you'd buy there. You'd sell there, and now you're out. You're still out. You wouldn't have bought there, right? Because it crosses back below. I guess you would have bought right here, though, wouldn't you? Yeah, so you would have bought there. That would have been a big, you would have sold there. So you would have bought there, sold there. It wouldn't have been a very good trade. That's the theory, though. Anyway, so what is that telling us? We're looking for momentum. We want shorter term momentum to be stronger than longer term momentum because that shows us, you know, we got some recent kick. That's what USA did. I'm not saying you have to follow that one, but that's how we did it. Right now, you're getting close to a buy point. The problem is that 100-day. And that's because that 100-day is really hit by this thing. The 50-day is coming up fast because you're getting rid of this one. So you're going to see the 50-day really jump up as soon as you get that day falls out of the data. But that day is going to stay in the data. And the 200-day has a lot of these higher numbers. So it's, you know, when you have a market, a stock going sideways, which is what Walmart has done, you don't get really strong indicators. Does that sound like a way to invest stocks? What's the big missing piece here is exactly where would you have bought? Exactly where would you have sold? As you're looking intraday, I remember one model that I was shown. He said, well, this model is great. You beat the market every time. And one thing I noticed on the model is that when you sold the Friday before Black Monday in 1987, but you sold on the Friday before Black Monday using data that you didn't have until the market closed. You're going to have a tough time selling on Friday if you don't have the data yet. And so he fixed his model. He changed one of the numbers by 0.1 or something. And so he sold a couple of days earlier. And so, okay, now you're data mining. He said, you just change your model to avoid that one bad day. So now your model looks really good. You know, obviously, if you take a 23% down day out of your model, you're going to look like you're a genius. So you got to make sure you can't say, well, I would have traded right here. Well, if you're waiting for close of day price, you have to change your back testing to buy and open the next day because you can't buy it closed. So don't have yourself buying at close using closing prices. That's really hard to do. It's impossible to do. So unless you're after hour trading or something. So make sure you're real clear on that. Are you going to use intraday prices? And if you do, you're going to use closing prices, but you have the day's price. And if you see it hit, you're going to trade right at that point. That gets a little complicated because you're close. What are you going to do? Sit at your office desk all day long just staring at the screen? Or do you have some kind of program trade that's going to do? You could try to put in a limit order, but if you put a limit order, that's going to keep changing every time the market changes. So it's going to a little tough. So you got to be real clear. I've seen people run these models and get really great results, but you can't execute it. So make sure you're real clear on the execution.
So is high frequency trading, is that basically an algorithm or software that?
I don't, it's probably technically based. It's probably the day traders. I'm not real sure where exactly that gets applied. I've never worked in trading in a trading desk, so I don't know exactly what you break up the different, the dark pools and all that kind of stuff. If we had Ricardo here, he could tell you all about that because that was his job at Goldman, huh?
They also have bots that search news releases and the second news, like they basically assign weights to words. And if there's a larger weight of negative words in an article that comes out of that company, it'll trigger a higher level of selling off the road.
There are a lot of computer trades going on now, no question that.
A technical buddy of mine that he trades crypto constantly, we use this app called Stock Twits. And it's basically like social media for stock trading, but you can see what they're buying and selling organically from like an institution level.
Yeah, the question is, does it actually work? Did it get you out of Bitcoin a few months ago, or would you still been in?
He's calling me at 2 a.m. sending me charts. So
yeah, I'm a very fundamental guy. I like to look at the business kind of more Warren Buffett type. I doubt Warren Buffett does much of this kind of stuff. It's just to me, this is a little too much reading tea leaves, but all right, so some kind of moving average. What else could you do? So let me show you what Bloomberg has. So this is a paper you could definitely sit down and do at the Bloomberg machine in not that much time. So if you type, so I typed Apple, and then I typed Apple and hit the F8 button to say I wanted a stock, and then I typed TECH for technicals. And they bring up, they have 104 technicals. You only have to pick 3. So you got 3 to go. They have popular ones. Bollinger Band's probably, I mean, you have to do moving average, but Bollinger Band is probably the most used in the class, mainly because it's the easiest one to explain. So a lot of students like that because it's real popular. It's a good one to know. Very easy to explain. I'll show you a Bollinger Band here. They have some new ones, a lot of momentum oscillators, statistical support resist. There's all a bunch of different ones. You can see the names can get pretty wild. Parabolic studies, rate of change. The RSI is another really popular one. I don't think it really works all that well, but it's another really easy one to explain. So a lot of students like to use that. Essentially what that's trying to tell you is overbought, oversold. If the stock drops too fast, you get a point, you can buy it. If it rises too fast, it's overbought. And so that can be an interesting one. Simple moving average is what we just did. If you don't want to do what I just did, then you just click on that one and it'll bring it up for your stock. Stochastics, trading envelopes. I don't know what that one is. William percentage R. I have no idea what that is. But you have plenty of choices. So what I'd recommend you do the moving average. Maybe do a Bollinger Band or relative strength index, an easy one, and then try to find one wild one that if you talk about it in an interview, they would be really, really impressed. It's like, yeah, I really like the Ichimoku indicator. And this one's a really hard one to explain. If you look at it, my word, it's 3 things going on at once. It looks really cool because you have these really nice, beautiful clouds and all this wonderful stuff that looks really cool. But if you can't explain it, I wouldn't put it in the paper. So make sure you can actually understand it. Here, if you click on all studies, you can see what they have. So we need to get some of y'all's names on some of these. So we'll get the Gallego pattern chart. Fibonacci is a real popular one. I like Fibonacci because it has a musical connotation, and so I like musical. I like things that work in finance and in music. That's kind of cool. J.S. Bach was a big Fibonacci fan. So you got a lot to choose from. So what I'd recommend you do, find, if you can't choose, Bollinger Band, RSI are the 2 easiest ones, but find one that's pretty simple and then go through here and click on one chameleon trend. That sounds pretty cool, doesn't it? Click on that, read the description. Let me show you what they give you. Read the description. Here's Bollinger Band. Read the description. If you read it 3 times and you have no clue what they just said, then click off of it and go to another. Right? You don't waste time trying to figure one out. This one's pretty straightforward. Using the standard deviation of the moving average. That's really simple, right? Just take the standard deviation moving average. An excellent measure of price volatility. The study plots lines above and below the moving average at specific number of standard deviations. This study is used to identify periods of high and low volatility, as well as periods when prices are extreme and possible unstable levels. To me, it's like a really good RSI indicator. It works really, really well. Let me show you one. So here's the Bollinger Band for Apple. So the width of the band depends on how volatile the stock price has been. So the band widens and narrows, and then you're looking for buy points at the bottom and sell points at the top. You can see how it just been following that just perfectly, and then it breaks down and it follows it there. So you're worried if it breaks above that it's going to get unstable and come rushing back down, that it's just moving too fast. This was, I think, probably 50-60% of the students did Bollinger Bands just because they're by far the easiest. But see what I just did there? I have Apple in there, and I just click on the chart. Everything, you don't have to build any charts. They're all sitting right there. So they make it as easy for you as possible. Have any of y'all done Bollinger's? I could probably build one myself, I think, pretty easily on what I just showed y'all. And then here is the, y'all know how to pronounce this? Ichimoku Kinko Ai equilibrium analysis that was developed by a guy not even named any one of those names, and is commonly referred to as that thing again. These charts combine 3 technical indicators to define price trend. Look how cool they are. Isn't that really cool? That would look really good in your paper, wouldn't it? Wow, I'm hiring a student who understands this stuff. That's HR people really impressed, but it looks really cool. And what is even more cool is part of the chart is after your latest price. So it's actually kind of going out into the future. Here's all the formulas. You got all of that. There's the rest of the formula. So you're going to have to explain that in your paper. So if that doesn't make sense to you, don't put it in your paper. Okay, don't give me something you don't understand. You don't want to bring up something like that in an interview either. The Bollinger Band is pretty easy to remember and explain. This one's, I think, a little bit tougher to explain. Have any of you ever used this chart before? You are technical traders. I've had 2 or 3 students bring that one in just because I talked about it. Fibonacci, you have these patterns. Have y'all seen Fibonacci before? 0 + 1 is 1, 1 + 1 is 2, 1 + 2 is 3, 3 + 2 is 5, 8. And when you divide one versus the other, you get these sequences. And essentially what it's saying is these are really important sequences in nature. When we hit them, they tend to give you information. And so, yeah, you can bring up the Fibonacci and look at it for your stock to see if they're hitting one of these really important points. This is seen all over nature. We see Fibonacci all over the place. I remember studying Bach when I was in college. We spent an entire semester just on Bach, and Bach uses the climax of his pieces of music are at the Fibonacci sequence. Pretty amazing. And I don't even know if he knew that. He may have just been such a genius when he wrote music. Maybe he did, but pretty amazing stuff. So that one can be a good one. Here's the actual Fibonacci for Apple. So are you worried? Yeah. Are you excited? Yeah. So it gives you some sense of, wow, I think we're getting to a point that psychologically is really, really important. So that could be a good one to do. So you've got plenty of choices. So all you got to do in the paper is you provide the momentum, you get the chart, you explain what it's telling you. So you got to explain the technical, then you got to explain what it's telling you about your company. I've had some students that have put the technical in there, explain what it is, but don't tell me what their company is doing. Is this positive for your company or negative? If they're getting to an oversold, an overbought level or an oversold level, do they have strong momentum? Is the momentum looks like it's maybe turning, or are they kind of going sideways? Make sure to say that. Since you have 3 of them, You also need at the very end to have a summary of overall, what is it telling you? Is there any preponderance of the evidence of the stock having any kind of technical strength going to it? Which means you probably don't want 3 that are all momentum based. So you probably want some oscillator in there. So you have some kind of standard deviation or something, add something so you have a little bit more to talk about. But that is papers 8. A lot of times paper 8 is only 3 or 4 pages. And, it just doesn't. So I think I've had some that were 2 pages and did all right. So it's a pretty easy paper. I think it's a paper you could probably write in 2-3 hours just at a Bloomberg machine. So it's a good one to leave until the last week of class, and don't even worry about it until then. Okay, sentiment. What sentiment is telling you is there's certain investors that are always wrong. We want to know what they're doing. So newspaper headlines are always wrong. They talk about how the world's coming to an end right when it's about to turn around. So those can be pretty good. Small investors, odd lot trades, put call ratios can be really, really powerful. Puts are bearish, calls are bullish. You look at the ratios, you get the sentiment. Is the stock more bullish or more bearish? You can probably do the same thing with short sells, short interest as well. Short interest reflects strong sentiment on a stock. Mutual fund cash holdings are usually highest at market bottoms. Even though they're institutional investors, they're more marketers than they are investors. So institutional investors are usually pension plans and hedge funds and those types. Mutual funds look more like retail investors because they're trying to appease to the retail crowd. I don't know if y'all have heard this comment before. Cash on the sideline. Have y'all heard that before? There's a lot of cash on the sideline. Yeah, there's no such thing as that. It's impossible for there to be cash on the sideline. And why is that? If a mutual fund sells its stocks and gets all this cash, what also had to have happened? Didn't someone have to buy the stock? So every stock sell has a stock buy. There's no such thing as cash on the sideline. So what we mean by cash on the sideline is mutual fund or retail cash is on the sideline. When the retail driven investors are holding cash, that means you're probably at the bottom of the market. Margin balances, that's when small investors, they really leverage up, probably at the top of the market. And then this is kind of sad, but what are those financial advisors saying? If they're bullish, then you probably want to sell. If they're bearish, you probably want to buy. That's pretty sad, right? The people who pay to give advice are, and why are they doing that? Because they usually give the advice that their customer wants to hear. If you're in the middle of 2008, the last thing you want to hear is you should be buying now. Because what happens if you say you should be buying now? You buy and the market falls 10% and you're like really, really mad. You're better off saying, oh, let's stay out for a while. And the market comes back, you say, yeah, I think now it's time. They're not going to say, well, you should have got me in earlier. No, they're just freaked out. So mutual funds and advisors are more marketers than they are investors. So market strength, you can't use this for individual stocks, but it does work very well for markets themselves. So how much breadth or how much strength does the market have? So 1998 is the perfect example. The stock market's soaring, and yet very few stocks are up. Very, very thin market. So there's a few massive .com stocks that are up a bunch, and the rest of the market's just flat. So that gives you a good sense. So you look at the advanced decline. You don't care about how much the stock is up. You're just looking at how many stocks are up versus how many are down. At the end of a bull market, you'll notice the stock market's up, but there's more stocks down than up. And so what's happening is you just got, those last few stocks have been driving the market. They have their last little hurrah, and the market's about to go down. You can look at 52-week highs versus 52-week lows and kind of see what's going on there. You can look at large cap versus small cap. That can also be a good indicator. That worked really well in 1998 as well. Dow has a lot related to different sectors. So he liked to look at transportation versus industrials. No telling if that still works today. I've seen some use utility stocks as an indicator. The key with transportation stocks is when the economy starts turning, the transportation people usually notice it first. Because people start buying stuff and they start noticing, hey, a pickup, we're starting to see stuff. And that tends to get into the numbers before you see it in employment and see it in GDP numbers. So looking at different sectors can be an indicator. So those are the kind of things you can do for technical analysis. Some of them work for stocks. They all work for markets. If you're looking at the S&P 500, you want to know when to get in or get out. You can use all of these for these. You can't use all of them for individual stocks, though. Did I leave any out? I was looking through DowQuest to try to see if there's anything else in there. I mean, there's 80 or 90 under each one of these categories. So everybody's out there looking for some trick. My guess is Ned Davis knows all of them. So that's a good place to go. If any of y'all have Twitter, since I don't, and you want to look up Ned Davis, let me know if you find something. I'd be really curious to see what's out there, because I don't want a Twitter account. I've got enough. All right. You got to be careful with the data mining. That's what I think that one guy was doing when he had his strategy. He just kept adjusting the numbers just enough to kick out these really bad markets. And it's like, yeah, that's probably not going to work. So you trying to avoid being fooled by the randomness of market. Just because it worked in the past doesn't really help you. One thing this guy did on his model is he over tested it. So really key is to have out of sample tests. He went back with all the history you possibly could find and he built this model. Well, he should have left himself a couple of 5-year periods. So he could say, okay, I'm going to do everything except for 75 through 80 and 90 through 95. I'm going to test everything else. That way you can see, oh, I got this model works really well, and then it doesn't work in those 2 5-year periods. You got to say, okay, you're overfitting the data. So if it works in the past and it works out of sample, now out of sample, hedge funds think of out of sample in broader terms. So they may say, wow, this really works well in the US. Let me try out of sample by looking at European stocks, looking at Asian stocks. That can be out of sample. Or it works really well with large cap stocks. Let me see if it works with small cap stocks. Because it's unlikely that investors are radically different. So, but usually out of sample means outside of the date range that you tested it on. So leave yourself. The best out of sample is the future. That's what hedge funds do. They build a model, they get it working, and then they put it in an incubator for 3 or 4 years, and they see if it actually works. That's the best out of sample you can get. If it worked really well in the past and then it doesn't work in the future, then maybe it wasn't such a good strategy. So out of sample is really important. But even if it works, you got to try to figure out something, and this may contradict with what DowQuest says, but I think you have to have some rational reason for why that's the case. I talk about small versus large investors and all these kind of things. Why is it that you see that particular pattern? What are people doing? And then once you figured out, you got to think, is there a reason why this would continue in the future? So we used to have small caps outperform in January. People say, well, why is that? Why do small caps do well in January? Well, the rationale people came up with is in December, managers want the large companies everybody's talking about, so they stick them in the portfolio at year end. And then in January, they sell those and go out and buy the stocks they really want. Okay, that kind of makes sense. But then the small cap phenomenon disappeared. Why did it disappear? So, you know, you kind of trying to, maybe that wasn't the reason. Some people said there was some tax harvesting going on. That could have been a reason. Who knows? But have some reason for why that would work. I think to me, one of the coolest ones is the presidential cycle. Jeremy Grantham is the big one on that. So it's amazing. You look at his analysis, how incredibly this thing worked until President Obama. And President Obama, it completely died. And why did it die? He thinks it's because after the 2008 crisis, the Federal Reserve went crazy. And the Federal Reserve started doing stuff that had nothing to do with history, and then suddenly it just disappeared. But if you look at it prior to President Obama, it really had nothing to do with President Obama. You should get his chart or try it yourself. It is amazing how which year you are in the presidential cycle, how different stocks perform. it's overwhelming. It wasn't like on average this year does better, but it was every single time this year does better than the other three. Pretty remarkable. So then you have to ask the question, why is that? So the argument there was, well, it has to do with the election cycle. Congresses tend to spend a lot of money before the election, so they have something to talk about. That tends to give you a strong economy, and stocks do well. So why did it disappear? Because the Fed said, you know what, let's just put the pedal to the metal forever and ever and ever again. And so who knows? I don't know how you can go much more to the pedal than giving people $1,200 checks. And so that's what you're looking for. So you have firms like Ned Davis that are essentially looking at every single possible combination of data that you have to realize if you're looking at billions of pieces of data, you're going to find strong relationships with two things that are completely unrelated just because of random chance. So, you know, like the NFC winning the Super Bowl or whatever. And they even had an argument for that. Well, NFC, there's more New York teams, so Wall Street's happier. And it's like, yeah, I don't know, I don't buy it. All right, so which ones are going to put in your paper? You have to put that one. RSI, Bollinger Bands are real popular because they're simple. Trend lines, resistance, support, trading ranges. The MACD is just a moving average, but it has extra charts put in there. I say BTST, but it's really, that works as well, but tech works as well. If you want some other ideas, there's some really good websites out there. Or use the one Anthony was just talking about. And they'll give you some ideas on some ones that you want to maybe use. Chandelier exit, that sounds pretty cool, doesn't it? There's good old, what's his name? The Kaufman adapted moving average. Now you have to go and look and see if it's in Bloomberg, or you got to create it yourself. A unique, that's cool, moving average that accounts for volatility and automatically adjusts to price behavior. That sounds like Bollinger Bands, but maybe it's not. Keltner channels, moving average ribbon, moving average envelopes. I don't know the difference in ribbon and envelope, but probably something there. Yeah, you can, they have quite a few there. Zigzag, that just sounds like someone just making stuff up. That looks like kind of support resistance kind of trend and channels and all that kind of stuff. Stock TA, I forget who gave me this one. It has some good stuff in it. It's not coming up. And in good old FinViz, although I think FinViz charges money for a lot of what they do. So I'm not sure what you can get access to, but they have some pretty good charts as well. This is one of my favorite charts. It has nothing to do with this part of the class, but they have some pretty good charts. And if you click on a company, see if I can find a good large company here. You can see they get the signals right there. Oversold, most volatile, most active. Right, so you can see they give you, oh my word, that's an interesting. I think probably something happened on that day, but they give you some interesting charts as well. I don't know how their computer does this. Anybody have a clue how their computer draws these lines? Doesn't that look pretty complex? How would you actually get a computer to figure those out? There must be some algorithm in there. They're using candle charts, so they're picking something on the candle. That was not a very good one. Let's see if I can find a better one. I'm trying to find a company I know, but I don't see one. Double bottom, let's see what that looks like. What does a double bottom look like? Yeah, there's a double bottom. Yeah, how did they draw these charts? Did they have someone physically going in and drawing these? At USAA, that's what we did. We physically drew them. And it really bugged me because my CFO was doing the line and says, oh, that's 500. 500. So I did it statistically, like with the least squared, and it was actually like 780. It's like, you know, it's really more like 780. Oh, no, it's 500. And he's looking at it. It's like, okay. But do y'all think they're drawing these by hand, or you think they got a computer model? Think it's a computer? Would you be able to write a program that could do this? That looks pretty complicated to me. So I don't know. I don't know how they knew that was the point,
It's the volume is on.
and that was the point.
Bar chart is on the bottom of that graph, that's the volume.
Yeah. But I don't know if they're using volume in here as well. This one's pretty easy, a double bottom. So what does a double bottom mean? You have to look that up. I don't know. I don't even know what company this is. And if you're a technical trader, you may not care what the company. You may not know what they even sell. Who cares? That guy that was working for Wellington, he didn't know anything about management or he didn't know what products they sold. All he knew was the technicals. And even with that, I mean, it's amazing how horribly badly he did, or maybe it's not amazing. So anyway, this one gives you some interesting charts that you can't get out of Bloomberg because they draw all the lines. So if you're looking for, resistance, channeling, bottoms, tops, those kind of things, they have some pretty cool charts there as well. So did stock TA ever come up? Error. So malware website warning. Okay, I guess I won't infect UTSA. All right. So we've got the last paper we're going to do is the exec summary. And then at the end, if we have some extra time at the end, rather than giving new stuff, we'll talk careers in securities analysis, give you some sense of what this industry looks like. So this next week, Sunday after Thanksgiving, you should have paper 7 completely done. We want to use those last 2-3. Well, we have until what? About December. You have until grades are due, and that's always a Monday. I don't remember when grades are due, but probably on the 12th. So you have until the 11th. I'll stay up till 3 a.m. grading, so I'll give you until 11th. But you want to use those last 3 weeks for get the technical paper and exec summary real fast, and then you want to be fixing your papers. You don't want to be still working on paper 3's first draft at those last. You just can't do it. It's just not going to be possible. All right. Questions on anything? So I've only gotten like 2 people saying they're going to meet with me next Tuesday, but I'll be here. So email me if you want to, and give me a time because I'll set up times like 30-minute blocks. All right, we'll stop there.